For those that are that are listening to this on YouTube, this is a Q&A for the people that are subscribed to the Brooks Trading course or the Brooks Trading Room. And this audio will cut off at some point, but this is going to allow people to listen in to questions being answered. Someone asked a question of how long have I been studying now? Pretty much for 10 years at this point. So it was around late 2012 when I really started studying now. So it's basically been about 10 years. So here is the first question they said on, and by the way, these questions, they can be anything trading related, and or if it's related to the E-mini over the past week or so. When you're asking the question, try and reference a bar number, and that way a bar number with the day to make it easier for everybody to understand the question. So I'm going to delete some of these lines, and this question is about Thursday. And if there's any audio issue, please let me know. So I'm just going to remove some lines really quick. And just to verify, can everyone hear me okay? So first question on Thursday, I wanted to talk about the difference between bar 5, and which is here. This is bar 5. And bar 30, again, here's bar 30. And they also said if bar 5 had closed on the high of bar 3, so if bar 5 would have closed all the way up here, Al said he would have bought for a swing, pretending it had closed there. Can you explain why the bar wouldn't be too big? Yeah, so let's just talk about this bar real quick. So bar 5, the reason why a lot of traders would not be as interested in buying above bar 5 with the way it is for this reason right here. If you bought above 3 and you bought more below 3, look at the high of bar 5. It's at the midpoint. And you can also argue if you bought the low of 4 right here, the bar 4 low, which it's making it really, let me try one other thing really quick here. I got to share the whole screen. The bar 4 low right here is 39.75, and the high of this bar is 44 even. So a lot of traders that bought scalped out. So the problem with this bar is you don't know if it's just traders buying and scalping out as the bar goes up. If it would have been bigger, that would have been more of a sign that traders were buying into the close. So that's why bar 3 is possibly a trap. It's also a big bar on 4. And the other problem with buying above 3 is if you're buying above 3, the risk is it's a two-legged pullback, rally, pullback, second leg, because this bar 1 and 2 are probably going to get a second leg down. Now, as far as, can you explain why? So as far as bar 30, what is the problem with bar 30? Why is bar 30 too big? Look at the moving average. Bar 30 is forcing someone to buy right at the moving average, and it's a lot of overlapping bars. So it's a problem for the bears. It's a second entry buy at the bottom of a trading range. However, What we don't know is if this is a sell vac or a buy vacuum test of the moving average. And then bar 31 is a bear bar closing on its low. We had that similar to yesterday. Here, we had a rally on 54 and then a sell off to a low 2. So it's hard to see. Let me kind of make it bigger. So you get a rally on 52 and then a pullback, and then 54 is similar to a second entry buy. And then you get 55, a bear bar closing on its low. That was the risk over here. But the odds were this bar is a credible buy. Even though it's big, it's a credible buy. The problem with the buy, though, is the risk is big. It's forcing you to buy high in a relatively tight trading range. Do you ever trade large, or do you pretty much always trade small and willing to scale in? I have learned through trial and error and just a lot of mistakes that for me, I like trading small and scaling in. And typically, if you want to talk about, an equity curve or performance wise, I've found that when I start trading too large, I care too much and the performance goes down. So, if you have I'm going to see if this is going to work. It might. So if you have an equity curve, a lot of traders that scalp, they try and make an equity curve more kind of flat. And the problem with, a lot of when you start trading too large, and this is a new feature I've never really used, so I don't know how to erase the pen. I guess I can do that. So interesting. Okay. So the problem with trading large is you'll often have greater losses, and that's a lot of traders. And, sure, with time, traders can. I'm going to try and just go back to, try and get rid of the pen and go back to this. In time, a lot of traders can trade larger and be more comfortable. But I think a lot of traders naturally trade small and build up positions. And for the reason is if it's kind of like if you trade a full size position on every trade, then you run into problems because what if you sold the close of 2? Well, what do? Do you just get out break even here? It'd have been a lot better if you could sell the close of 2 and then sell more above 2 or even above 3 for a scalp. So it seems backwards when you're scalping and using wide stops, you trade a lot smaller, but you can take a lot more trades. And if your probability is high enough, you really won't have as many losses. So when you look at the performance of a week, it can be a lot stronger than trading a full size position. And you're more likely to be comfortable. If you're trading small, you're going to be comfortable more likely with what you're doing, and there's less of a risk of doing something that is dumb in the sense of damaging an account balance. Is there a specific way Al looks for the HODL? The person asking this, do you mean I'll sometimes reference a hodl trade, hold on for dear life trade when a stock goes really low, or are you trying to say something else? But I'm going to assume you're talking about the acronym hold on for dear life. And what that means is, let me pull up another chart. So Al will sometimes reference that as a hodl trade. And that is basically when, GE was a good example of that several years ago. So you can see GE on this chart right here was at there's a red line right here. And it's one of those things where a hodl trade is a stock has just really, bad performance and you're buying it because it's so cheap that it makes a lot of sense to buy and it provides, strong risk reward. So a lot of traders, they looked right here. This was in 2018. It went from 80 to 43, it almost came to 40. Now, I don't remember what GE was at. I think it was at $5 a share. And Anyways, they revalued the stock, but at this point, traders buy, and they buy because it's at 40. And the reason is, look at the chart. What's the chances it's going to go from 40 to 80, maybe back to 100? An easier example is right here. This was in the COVID crash, 2020. Price went to 39.97. And then you can see right here, price went to 36.83. So if a trader bought the low of 2019 during the COVID era of 2020, they would have had $3, let's just round it to $4 a share actual risk. And at the worst case, they, let's say they buy however many shares. Worst case, it goes to zero and they lose their investment. But if it's at $40 a share, here's 80, here's 120. So the risk reward is actually really good, because a lot of stocks, no matter how low they go, typically don't go to zero. And GE is a pretty big name. And then you can see it went sideways for several months, but then it rallied, and it rallied up to about 80, and now it's at 102. So a trader that bought 40 had an actual risk of a few dollars, and the market went up to here. Carl Icahn, I'm sure a lot of y'all have paid attention to IEP recently. Icon's enterprise, Icon stock, and you can see in the past few days, the market sold off significantly, and it was paying a very high dividend. Here's a weekly chart. It's been going sideways for several months, and it was paying about, I don't remember the dividend, but it was really high. Anyways, they released some report saying that it's a fraudulent company, and it sold off. And a lot of traders, you have a lot of people even on, Yahoo Finance, CNBC, claiming that the report is misleading potentially, and that it's not a fraudulent company. So no one knows yet. But the point is, this is kind of a hodl trade example, hold on for dear life, because if a trader's buying here, they can buy and risk $20 a share. And, what's their downside risk? Well, if it goes, the stock, they're not going to lose more than their investment, because they're only obligated towards what they put into the company. So they're not obligated to any further liabilities than their investment. Therefore, if, let's say, this report is misleading, and what if the market goes back to 50? So the point is, it's risk reward. That happened in Macy's back in 2020. We go to a monthly chart, and hodl, they always look like really, these stocks, they always make it seem like the company's going bankrupt. But you look right here, and Macy's at $5 in 2020. But traders are buying because it's near zero. So they risk $5 a share, and it might go to 10, it might go to 20, it might go to 30. So they can get, it's not, you're buying it because it's so cheap that it might be the bottom. And if it is the bottom, you can get a pretty big rally and get 2 or 3 or 4 times your investment. And obviously here, a lot of traders, they got probably 5 or 6 times their investment if they held up to here. So here's a question from the Discord page. Someone asked if I use trend lines, and I use them pretty frequently, but I can see, I guess the longer I've traded, the more I can see on a chart and just kind of envision things. So I don't need to draw a trend line for this to be a wedge bottom or this to be a wedge bottom and various things like that. So here's a question about, someone asked about the Brooks Trading Course video 30E. He states that 90% of the bars have at least a 40% chance of going X ticks up before going X ticks down. And then he says at the end of the segment, you also have 40%. I'll look back at that in just a few. So I'm gonna look at some more questions, because that will actually require me to go into the video course, but I'll take a look at it here in a bit. But how do you find those hodl trades, hold on for dear life? You look for them in, you look for stocks that have strong risk reward. So it's kind of like it's like a Walmart trade that Al talks about. where if a trader that buys above 30 on Thursday puts a stop below and they hold for twice the risk, it's good risk reward. A better example is Friday. So here is Friday, and we have a strong bar 1 and 2. Traders buy the close of 2, stop below 1, and Al always says they go to Walmart or they they do something for 30 or 40 minutes and then they come back and the market's somewhere up here. That's kind of an example of one of those trades. Just make sure of something really quick. For those on the GoToWebinar, can someone type in that they can hear me? Okay. In the GoToWebinar box. Okay, perfect. That's good. Thank you. So looking at more questions here. Okay, when you're trading the 5-minute, how significant are highs and lows, patterns, etc. on other time frames? Do you pay attention to the daily, hourly levels of support and resistance, or is it just part of the pre-market prep? Yeah, since I write the blogs every morning, I look a lot at the pre-market, and in a way it's helpful just because it forces me to think about the daily chart, forces me to think, when I'm writing the pre-market, I look at the daily chart. And I usually use this screen right here just because it's got all the charts on it. And then I'll pull up the Globex chart. I'll go to I'll start with a 60-minute chart, just glance at it. But it can be helpful. And, for me, the first thing I'm looking at is the open. That's really the number one thing I care about is these bars right here. What's the open going to be? Is the open going to be a doji? Is the open going to be a consecutive bull trend bars like this? One thing you can do if you're looking at the pre-market is or the Globex chart is you can actually, let me try this. I'm going to open up some charts, but they're going to take a second to load. But anyways, one of the things you can do is if you get a rally on the open, look at the Globex chart. So here, this is the first bar of Friday, and look what it's doing. It's breaking out of a lot of bars to the left. So if you're buying the close of one, the context actually makes a lot of sense. It's a bull breakout of a trading range since, late last night, and it's a tight trading range. So reasonable to think that the market's going to get some kind of measured move up of the opening range. But you don't need to know that. If you look at any day, let's just go to here. I'm going to scroll back for just wherever, and let's just go to this next open. And I do this. I do this a lot. I just scroll to random days and just look at the chart. But here's the open right here. So this is the 31st of January, 31st, 2023. When you're looking at this, ask yourself, do you think you're going to have a really strong trend? Or do you think you're going to have a trading range day? You're probably going to have a trading range day. That is not like bars 1 and 2 and 3 today. And whenever I see bars 1, 2, and 3, one of the things I'm always doing is I'm always trying to rule out probabilities of things. So on the open, you're either going to have a trading range day, bull trend day, or a bear trend day. And one of the things I'm always trying to do is figure out how can I rule out one of those factors. So if we have 3 big bull bars on the open, I'm thinking it's either a bull trend or a trading range and not a bear trend. So I'm much less willing to sell, and I'm especially much less willing to sell low in the range. Bar 1 and 2 is the opposite. Bars 1 and 2, it's a bear breakout with follow through. Yes, it's a gap up, so you have a big up, big down. But with these 2 bars, it's likely not to be a bear trend. It's likely not to be a bull trend day. So for me, the only thing I'm willing to do here is either look to sell or sell a pullback. If I'm buying, I'm only buying if I think it's a trading range, and I'm very careful about buying up here. If you were in the trading room, you heard Al say that it's dangerous to buy up here. The bulls were trying to get a measured move up, but they're buying high in a trading range, and then there's no surprise why that happened. But for me, you know, you can see there's so many different support and resistance you can draw. I mean, if you really want to, you could find everything, round numbers. So 4,200, that's one open of the week. In general, like what am I going to do on Tuesday since Monday's closed? I'm going to take this chart, I'll get rid of that. That was the close of this bar. I'm going to take a few things. One, I've got the May 19th high, this high right here. But the first thing I'm going to look at is the high of yesterday, which would, in this case, would be Friday. Whenever I say high of yesterday, I'm referring to the prior bar, this high, and then I'm going to take the low of this day. And my first thought is, what's bar one going to look like? Bar one can really give you a significant amount of information. It's really shocking. That's why I say all the time in the pre-market, a lot of traders should wait 6 to 12 bars, because if they just wait 6 bars, you can get a ton of information on how the day is going to form. So if we just go to a random day, we have a huge gap down. There's going to be a second leg, and then you get 2 big bull bars, but they're not that big. It looks like a leg in a trading range. And then you get a sell climax, and then you go sideways, and you get another sell climax, and you go sideways. So you have a parabolic wedge bottom. You're probably going to form a trading range and go sideways. But this channel down is so tight, it's probably not going to be a bull trend day. But anyways, all of that is in the video course. Do I use hotkeys for entries and exits? I know you can do that with TradeStation, but I've never done that. And, part of my concern with it is I'm just afraid I'm going to accidentally enter an order. So if control shift is to buy at the market, what happens when I click control shift accidentally and buy something I don't want to buy? And the other reason is I don't have a need to. Typically when I'm trading, I've got the matrix here, and then I've got a chart over here. So, for me, I can just click buy or sell at the market, and that works pretty well. And I can hit limit orders. So, unless you're, you know, sure, it could save, fractions of a second. But the reality is, if I'm watching the chart, I've got the matrix here. If I really want to get in, I can just click buy the market and get in. Okay, question on hybrid on 5/24 of 2023. Thank you for adding a date. 30-minute chart. Was there any trades? Sure. So let's go to a 30-minute chart of 5/24. So for me, if I was going to trade a 30-minute chart of the E-mini, I'm probably going to trade Globex. And the reason is it's going to be more or less a continuous chart. So if I'm looking at 5/24, we're in a bear channel, strong bear breakout sideways. So it's always in short. A lot of traders, you could sell at the moving average, consecutive bear bars here. Some traders will sell that close, stop above. Lots of bear bars down. First reversal up probably will fail. You have a trading range around this red line. So you expect bulls buying, scaling in. They're going to be disappointed. So bears are selling here. That's one way. If you're limited to time, I would certainly consider looking at the Forex markets. They can give you a lot of really good trades, and you can trade 30-minute charts, 60-minute charts, and it can be very helpful. But overall, you were in a bear trend there. What's the best way to utilize the Brooks Encyclopedia of chart patterns? For example, how could I have used it this Friday on 5/26? So how could I have used it? Let me try and get this thing to scroll all the way. How could I have used it today? Yeah. So to understand the midday structure of bar 50 to 57, well, in part, you have to understand this day. So here we had a bull trend from the open. And because of that, whenever you have a bull trend from the open, if I was looking at the encyclopedia, I would go to the section where it talks about, I think it's like part 13 or 12, gap up trend from the open. And I would look at the trend from the open section and I would know there's a 60% chance that the market is going to go sideways. So if I'm looking at that, you have, there's sections in there that talk about it. But as far as what do you do here, this was a trading range, and it's very common for trading ranges to get 2 or 3 legs down and test support like the open of the week and then reverse up. So that is how I would use it. And if I was going to do that, let me just pull up an example. So here is the encyclopedia of chart patterns. And what I would do is I'm going to look up gap up and I'm going to take a look at gap up, B1B, trend from the first bar up. And here is an example of common situations. So 20% of the time you get a bull trend that continues all day. 60% of the time it becomes trading range. So I already know here's this structure. So why did this happen? Because it's consecutive biclimaxes and it's too climactic to last all day. And another way I can look at that is I know that small pullback, bull trends last a long time because I think that was a good example. This is too many consecutive bull bars, more likely to be exhaustive, increased chance of a trading range. This is kind of like Friday. But if I want to go to another day, let's look at this day. Way less climactic, big bull bars sideways, bull bars but small, and it just kind of grinds up all the way without being too climactic. But the way I look at this is I would try and understand where the overall slides are. I wouldn't get, I would try and first be able to do this. If you have the encyclopedia, which you should, it's definitely worth it. I would take a look at how do I find, I would look at gap up and gap down. So I would try and find, okay, when you get a gap, what are the most common outcomes on a gap? So that's going to be 4 common outcomes. I talk about this every day on the pre-market reports. I say that here are the most 4 common outcomes of the day for a swing trade. And they're especially common when you get gaps, but you either typically get a double bottom and then a swing, double top and then a swing on the open, a wedge bottom and a swing up, or a wedge top and a swing down. And the reason is because most of the time the market's in trading range. By the way, one of the things I like to do a lot is I will take a look at this is just some basic thing. I try to make slides every day about the overall context. And I showed this one the other day, but this is the pre-market. This is a 15-minute chart of the Globex session. So here, I'm just going to fix that while I'm talking. 15-minute Globex. And you can see we had a big sell-off after a gap. But if I look at the pre-market to someone's question, I can see it's a sell climax testing the high of 1. So it's testing support. Odds are you'll get a second leg, but if it's a trading range, it could be a trap. And you can see this continued sideways because this was the rest of the day. Let me take a look at some more questions. Okay, question. Can you tell from experience when trading always in and scale in? In other words, buy more on every bull candlestick. Where's the point that you stop to buy more? because if I buy higher, the greater the risk to lose with the latest buys. Yeah, so what they're asking is right here. And what they're in essence saying is we had this day, let me look up the slide. This is a great example. What you're talking about is this situation, 428 of 22. So I'm going to go to this chart. Here's 428 of 22. And this is the 5-minute chart of this day. And what what this question's about is basically if you have a buy the close rally, if you're buying every close, you buy this bar, buy this bar, buy this bar, and you continue to move your stop a point or two, or maybe a measured move, the average bar below each bar, and you buy all the way up. And if you do that, you can make, an incredible amount. But the problem with that is most buy the close rallies don't last this many bars. This is an extreme example of a very strong buy the close rally, but most buy the close rallies are fairly disappointing. So if you're buying closes, buy here, buy these pullbacks. And then, what do you do here? Do you buy this close or do you buy this one? It's tough to do because most buy the close rallies are climactic. But for me, in general, most breakouts pull back after 5 or 6 bars. So a lot of traders, when they're selling closes, it's really hard. If you're selling this close 3, 4, and 5, and then you see 6, 6 is disappointing. And that's really hard to want to sell after you see that because the odds are it's going to start to go sideways, especially when you're on the open. So that is my thoughts there. And it really depends on the context of the day. Typically, on a trend from the open, 80% chance you get a minor reversal, 50% chance you get a major reversal. And the reason 50% chance you get a major reversal on the open is here. Because a lot of times when you get a large sell off or large rally, it's a sell climax test of support. I've got a lot of examples in here where you have, let me find a few. Anyways, here's basically one. You have a report, large rally, and then right on the 5:30 Pacific time report before the market opens. And then bar one was a large sell climax, but it's testing support. And then you got a second leg and a third leg down. That's different than, even here, bear breakout below a wedge. Odds are you'll get a second leg down. This is the Globex market. And the point with that is here, this is that same day that we were just talking about. Trend from the open, but it's breaking out late from the Globex session. That's a lot different than this over here. Tight trading range, strong breakout, and it led to 24 bear bars down. And that's similar to what we had on the open today, where we had, or what we had on the open on the 30-minute chart. Tight trading range, strong bull breakout on the open, and it led to a trend day. So let's take a look at some more questions here. But for me, I think a lot of traders, if you go back to the video course and look at buy the close or breakouts, most pull back after 5 or 6 bars. Okay, so question, what do you do when you're already studying everything you can? They've watched the course 3 times, they're in the trading room, they listen to they read all the daily reports, they watch all the daily end of recaps, they revisit notes, but still they're still somewhat not able to get out the same results they want. Yeah, it takes a fair, the reality is it takes a long time. And, if you really think about it, I don't know how long this person's been I don't know if they're talking about a year, 2 years, 5 years, but trading requires a lot of mental thinking. And, eventually, the more you think about things, the more it starts to make sense. And let me try and use this pen thing again. Here we go. So that will actually work. Let me do this. So a lot of trading is a lot of people that would say when you're learning to trade, it looks like this. So here is, understanding up here. And let's say this bottom is time. So here's time. I know this is really hard to draw on this. Here's understanding or knowledge. Let's just U for understanding. And it's flat. Some people call it kind of the hockey stick analogy, but it's real. Your understanding of trading is relatively flat, and it starts to go up, starts to go up. Then eventually, it starts to go up like this in the parabolic way, where once you start to understand more and more concepts, you can really begin to understand things at a much faster rate. And all of that just really takes time. The first thing I would ask yourself is, are you doing the things you shouldn't do? In other words, are you buying high? Are you identifying if the market's in a trading range? Are you buying high in a trading range day? So if we look at, let's just look at today, for example. I think it's really important to try and view things as far as binary decisions. I've often, if you're in the Discord, if you've been in the trading room, you've seen me show the flow chart or share it, and it's just a flow chart. Here's trend or trading range. If it's a trend, is it a channel or a breakout? If it's a breakout, is it strong or weak? If it's a channel, is it tight or broad? If it's a trading range, is it broad or tight? And anyways, the whole point is most traders do things, they don't rule out enough basic decisions. So like on the open right here, I'm always trying to rule out probabilities on the open. So when you get 3 consecutive bull bars, what's the odds it's going to be a bear trend? It's probably very little. Therefore, does it really make any sense to sell? Probably not, because at best, if you're selling anywhere in here, at best it's a trading range. At worst, it's a bull trend, which means it could go up a long, long way. On this open, if you have consecutive bear bars, it's either going to be a bear trend or a trading range. So if you're buying anywhere in here, it really doesn't make a ton of sense. And you have to be very careful because you can get trapped. If you're buying when you see 18, 19, 20, and 21, it's easy in a trading range to want to buy at the top because a lot of times in a trading range, you get buy vacuums to resistance. And the buy vacuum often tricks traders into thinking that the market's breaking out, just like a sell vacuum at the bottom, 25, 26, 27. It's a sell vacuum test of support, but it looks like a breakout, and it is a breakout. But the reality is it's a breakout because no one wants to buy up here. They want to buy at support, 12 low, and everybody sells until we get there. One of the things that's really important to understand about trading is you never know how many traders are waiting on the sidelines to enter. So we had that. I talked about that example on this chart actually right here. Whenever you see big bear bars and follow through, you never know if this is going to be a vacuum test of support. So when you see this and then you look to the left and you see it's a possible higher low, you always have to wonder if it is in fact a higher low. We had several examples of that over this week where actually we have one on Friday. Let's just go to that one because it's the most recent for everybody. We have this big bear bar right here, but it's testing the open of the week and it's a third leg down, 1, 2, 3, and it reversed up. So the first thing I would ask yourself is, are you buying at the top of the trading range? Are you selling at the bottom? Are you fading small pullback trends? So if you look at your losses, Are you buying? Are you selling when you see this? Or are you buying when you see, this kind of a rally? Are you trying to pick a top and sell? Are you selling when you see this? Are you selling after three legs down? The other thing I would suggest is to trade really small. And by trading small, it allows you to set aside emotions of, you can really not care. And give me just about 10 seconds, and I'm going to talk more about trading small and, what I really think are the keys to figuring out a lot of things. But it starts with trading small.